Hi, Abhimanyu. Welcome to our podcast. New measures have come from the RBI governor. Could you broadly explain how is it going to affect the NBFCs, banks, economy, government finances?
Sure. Thanks for it. So first of all, I think the RBI measures has such a welcome. If you look at the market, probably they were already expecting some of these measures. In fact, I think the market was looking in fact something more than what the RBI governor came up with. Coming to the specific measures, one they have done is TLTRO 2.0, which is a long-term issue that they're going to do of close to around 50,000 crores of bond buying. So exactly what happens in this particular case is that the banks get funding from RBI, and that money is utilized to invest in high quality, corporate bonds as well as NBFCs. Earlier also, we had seen that the RBI had told banks to do the same. In that scenario, the larger NBFCs were able to get the money. Now, specifically this time, it is targeted more at smaller and mid-sized NBFCs as well as MFIs. So basically, this can help for the retail NBFCs to get more money. In terms of some of these specific other segments of the market that the RBI is looking at helping out at, so for NABARD, they have talked about 25,000 crores, which basically helps on the agriculture side, the rural banks. Then you have the SIDBI, which will help on the MSMEs, that is close to around 15,000 crores. And for housing finance, they have given 10,000 crores. Overall, these loans will be given at the repo rate of 4.4%. So basically, the cost of that is quite low. The other measure which the RBI has announced, which is kind of a rate cut, is that the reverse repo has been reduced from 4% to 3.75%.
Right.
Now, this in a way actually becomes kind of a rate cut, and let me explain why.
Okay.
See, in a typical scenario, the reverse repo rate reduction, which is that the rate at which the banks, borrow money from the RBI, that becomes the benchmark key rate that people look at. But in the current scenario, when there is surplus liquidity, it is the rate which the banks are getting when they deposit money to the RBI, that becomes kind of a benchmark rate. So basically, to disincentivize the banks to park their money with the RBI, what they have done is they've reduced the rate from 4% to 3.7%. So which makes sure that people now, rather than putting money in with the central bank, gives that money more to people to invest in.
Okay.
The other thing which coming back to on the economy side, which they have done, state governments were likely to put in money at a very higher rate, expecting to borrow at a higher rate to make sure that, that doesn't happen. The WMA, which is Wains and Mean Advances, have been increased by 60%. So which means that they have a longer duration in which they can, look at their borrowing programs. On that way, they can ensure that they don't borrow at a very high rate. Some of the other measures that the RBI has announced is on NPA classifications, which was a 90-day moratorium from 1st March, which they've already said. So banks need to put a provisioning of 10% for these accounts. The problem is that the banks will have to do this provisioning, but if there is a credit risk in these accounts, then who takes that hit? That is a question mark that still needs to be answered, and probably it is the banks who have to take the hit right now.
Okay.
What they have also announced is that there will be no dividend by scheduled banks, and there will be a review of this decision by September end. The liquidity coverage ratio has been reduced from 100% to 80%. And there's an additional 1 year, moratorium in terms of commercial real estate shifting from a standard asset to a restructuring asset, which obviously led to more increase in NPS. So these are some of the key things which have been announced by the RBI in today's press conference.
Okay. Anything else you want to add, like will it help recovery, very sharp recovery? Money will flow because after 20th, if some establishments are getting opened. So what's your view?
So let me take for each segment separately. Like, for example, in case of the government sector, we clearly feel that, the fiscal deficit is going to come up now and probably go beyond 5%, maybe 5.5% to 6%. It is kind of a difficult thing to tell right now.
Right.
And considering the precarious situation in terms of how India is and how rating agencies might perceive,
right.
There is a clear case where you monetize some of the deficit. So what monetization of deficit means is that some amount of expenditure with the RBI is, which the government will spend.
Yeah.
The RBI, provides that money to the government and then in a way, prints similar amount of money. So this will ensure that the deficit, gets monetized, and that will be something which should have been done by the governor, considering the challenges that we are facing as an economy, and tax collection is going to be lower.
Okay.
With regard to NBFC sector, though a lot of the measures are quite positive, but I still feel that, nothing has happened in terms of who would take the credit risk, because clearly what has happened till now is that NBFCs customers are asking for the moratorium, which the banks are also giving. But at the same time, what money an NBFC has to repay, whether to a bondholder or to a bank, there is no relief on that except for this TLTRO, which has been provided now by the RBI. Coming to, other than the NBFC sector, the banks, clearly from a shareholder total return perspective, it's a negative that shareholders will not get a dividend. So that would be something which will be considered negative from a stock market perspective for people who are owning banking stocks.
Okay. And is the amount adequate, like the LTR amount for the not, lower rated NBFCs? Is it adequate?
So clearly it is not adequate as such because, 50,000 crore is quite meager relative to the problems that economy is going to face going forward. Collection also is not going to be pretty easy for an economy like India, because large part of our economy is unorganized. And since the people who have to repay the money, they don't have enough cash flow. They don't have a kind of a security in order to get money from somewhere in terms of an insurance that they would have taken in case of this kind of a natural calamity. So it will be very hard for them to repay that money. So the cash flow mismatches problem, I think so, is far bigger relative to the extent of TLTRO, which has been provided by the RBI.
Okay. So very swift recovery is not in sight for NBFCs at least.
Yes. So I feel that, until something happens in terms of either we see a substantial improvement in terms of the liquidity support being provided, or, there's a moratorium in terms of NBFCs loans that they have taken probably from a bank. Those are the key things which will drive people to lend more and get normalcy back. So till that happens, I think so it's going to be a volatile kind of recovery that one can look at.
Okay. Any investment strategy you want to talk about for retail investors in terms of stocks and sectors?
So I think so clearly, what we have been telling clients is that the way this market has been behaving, large part of the reason for the market to go up has been that the US market has done pretty well over last 2 weeks in the current scenario, because one, there's been clearly reduction in terms of cases that are happening in New York and UK. And secondly, another important aspect then one needs to look at is that, as said, the lockdown to some extent has been quite successful. So those have been the two reasons which have been there. So I think so 10,000 level for the index is the maximum that the index can go probably. And if it goes there, it would make sense for people to, get more liquidity back and not try to buy more, because I feel that, right now the economic situation is quite precarious. In terms of sectors, we continue to like the pharma stocks. Yes, they have rallied a lot over last couple of weeks, but I think so still it makes sense whenever you see some softening in those stocks to bet on those stocks. Chemical is another sector where we've seen a lot of companies have restarted production. So stocks like Atul Limited, Aarti Industries, Naveen Fluorine, Deepak Nitrite, those kind of stocks look quite attractive to us. And in addition to that, the insurance sector also looks quite promising to us, despite some leeway being given in terms of premium payments by the IRDA.
Okay. I think, do you want to add anything, or you?
No, so I think so. To sum it up, I feel that what we need to now look is what would the finance minister do. I think so. We have hardly seen any statement from the finance minister in terms of substantive steps in last couple of weeks. So we are hoping that the ball now shifts to the finance minister and we see some more relief measure for people to look forward to in order to spur investment back and consumption back into the economy. From a capital market perspective, I clearly see that people who have been investing in SIP and putting their savings,
Right.
I see that there could be a fall in that going forward because people need to have savings before they start investing. And since people have lower income this year,
Right.
so I think so getting the inflows for this particular year will be a bit challenging in the market.
Okay. Thank you, Abhimanyu. Thank you very much.
Yeah, thanks, Saurabh. Bye.
Bye.